Let us quickly go through the format to understand what are the items, what are the assets and liabilities, and as we progress with company accounts, each time we come across a new term, we will also discuss where in the balance sheet, where in the financial statements this particular item would be reflected. Now, this is the format of a balance sheet. It is in a vertical form, not the T form that we have familiarized with earlier. You have the name of the company and balance sheet as on a particular date. Balance sheet is on a particular date. Profit and loss account would be for a period. What is the format? We have particulars. We have a note number. This vertical format of a balance sheet is very compact. We get information here. The details of each of these information is supported by notes to the financial statements. So there is a note number. There is provision to provide the note number where details of all these items can be provided. Current year and previous year figures need to be provided. This gives us some comparability. So let us see what the format is. Here we first have the liability side. We have liabilities. It's in a vertical form. So there is equity and liabilities, and below there is assets. Let us discuss equity and liabilities first. Equity and liabilities. We begin with equity. What is equity? The owner's funds. Equity is nothing but the owner's funds. Owners in case of a company are called shareholders, and therefore the first item is shareholders' funds. Shareholders' funds, owners' funds. What are shareholders' funds? Under shareholders' funds, you have share capital. The capital in case of a company is called share capital, and owners of a company are called shareholders of the company. So the first item here is share capital. We shall discuss further what are the different kinds of capital and what are the different types of shares, but we leave that for later. For now, capital figure comes here, share capital. Next, we have reserves and surplus. What is reserves and surplus? Reserves and surplus is nothing but profit. Reserves is also accumulated profit, some kind of profit which has been maintained and reserved but not yet used, not yet distributed. Reserves normally we could divide into two. They are revenue reserves and they are capital reserve. Revenue and capital. What is a revenue reserve? Revenue reserve means the reserves which arise from revenue making activities of the business. That is the normal business activity. If it is a trading, the buying and selling, the normal day-to-day operations, the normal business activity of the company, the profits which are made from that, they are referred to as revenue reserves. The balance every year when the company does business, if it makes profits, part of the profit may be distributed as a dividend. Dividend is nothing but a return to the owner. Sharing of profits with the owner is called dividend. When we distribute the profits to the owner, it is done in the form of dividend. Just like we have interest on a deposit, we have dividend on share capital. Now, all of the profits are not distributed and some of the profits remain in the business. These are called revenue reserves because they are otherwise available for distribution as a dividend, but they have not yet been distributed and they have been kept in the business. These revenue reserves actually may be again of two types, general reserve and a specific reserve. So sometimes a part of this profit is kept for a specific purpose, and in that case it is called a specific reserve. We may have a sinking fund. There is a specific purpose for which the sinking fund has been created. That becomes a specific reserve. It may be to replace some machinery, some item of machinery. That is a specific reserve. A general reserve is a revenue reserve which has been kept, but not for any specific purpose. And a capital reserve again is a profit which is made not from the ordinary activities of the business, from some rare activity which happens once in a while. For example, we may sell property and make a huge profit. Selling of property may not be the business of the company. If selling of property is not the ordinary business of the company, the profit which is made from such sale may be retained in a capital reserve account. Similarly, we have something called a revaluation reserve. What is a revaluation reserve? Suppose we revalue land and think the value of land has gone up by 10 lakhs. Then we increase the value of land. Land account is debited with 10 lakhs and correspondingly a revaluation reserve is credited. That is also a reserve, but it is a capital reserve because it is not from the ordinary business activities of the business. Thus, reserves may be revenue reserve or capital reserve, and the revenue reserve again could be a general reserve or a specific reserve. Another item which comes as a part of the shareholders' funds is the money received against share warrants. Share warrants are warrants which entitle the holder to subscribe to the shares of the company at some future date. So if some money is invested with the company and the holders are given a right to invest in the shares at a later date, such money which is received against share warrants is shown as a part of shareholders' funds. So under equity and liabilities, first we have shareholders' funds consisting of share capital, reserves in surplus, and money received against share warrants. Next, we have an item called share application money, which is pending allotment. When we discuss issue of shares, this would be further clarified. But what happens is sometimes when shares being nothing but a share of the capital of the company, a share in the capital of the company, we receive the money, but capital has not yet been allotted. If such is the case, that is shown as a separate item, share application money pending allotment. This more or less covers the portion of shareholders' funds. What about non-current? Next, we move on to non-current liabilities. Liabilities basically are split into non-current and current liabilities. What are current liabilities? Liabilities which have to be met, paid off within a period of a year, within a short period of time, usually a year. Those are current liabilities. But if these need to be met, these obligations need to be met only after a year, after a longer period of time, then they are called non-current liabilities. So first we start with shareholders' funds, share application money pending allotment, and move on to non-current liabilities and then current liabilities. What comes under non-current liabilities? Long-term borrowings. We may borrow money from the bank. We may borrow money in the form of debentures, etc. Whatever long-term borrowings are there. Maybe debentures, maybe bonds, maybe from banks, etc. Next, we have an item which is called deferred tax liabilities. This too would be discussed at a different level, at a more advanced level. Basically, deferred tax liability or a deferred tax asset arise because there may be a difference in the profits that that are reflected in the financial books, and the profit which is determined for income tax purposes. Because of these differences in the amount of tax, we have concepts of deferred tax liability and deferred tax asset. Any other long-term liability, for example, if we buy machinery on hire purchase and the installments are paid over a period of 5 years, then the installments which are due only after a year, only after 2 years, 3 years, 4 years, etc., would all come under other long-term liabilities. Then we have long-term provisions. Long-term provisions could be for employee benefits like gratuity, etc. Under current liabilities, we have short-term borrowings. You take a loan, short-term loan, which has to be replaced, which has to be paid within 6 months, which has to be paid within 3 months, etc. Could be current short-term borrowings. Creditors usually are payable within 2-3 months, etc. In which case, creditors, bills payable, etc. would be an item of current liability. Any other current liability, maybe a part of this hire purchase which is to be paid within a year would come under other current liabilities, and any short-term provisions. One item here could be proposed dividend. Proposed dividend is an item of short-term provisions. What is a proposed dividend? Proposed dividend, as we said, is the distribution of profit to the shareholder. So usually once the accounts are prepared, the board of directors may propose dividend, and this proposed dividend is shown as a short-term provision. It is then approved only later, approved by the shareholders during the annual general meeting. Once it's approved, it becomes a liability and it would come under other current liabilities. Dividend payable and unpaid dividend would come as a part of other current liabilities. So what does the equity side, what does the equity and liability side of the balance sheet look like? Equity and liabilities, we start off with the shareholders' funds. Under the shareholders' funds, we have share capital, we have reserves and surplus, and any money which has been received against share warrants. We have another item called share application money pending allotment. Shares have not yet been allotted, money has been received. Next, we have non-current liabilities, and then we have current liabilities. Under non-current liabilities, we could have long-term borrowings, deferred tax liability, other long-term liabilities, and long-term provisions. We have similar headings under current liabilities. They are called short-term borrowings because we are talking of current liabilities being liabilities which have to be paid within a period of 1 year. Trade payables, any other current liabilities, and short-term provisions. This is the first half of the vertical form of the balance sheet as displayed in part 1 of Schedule 3 to the Companies Act 2013. Below this, we have the assets. The assets side again split into two, non-current assets and current assets. What are current assets? Current assets are assets which include cash or other assets which are expected to be converted to cash within a short period of time, usually within a year. And if they are not expected to be converted into cash within a short period of time, then they are called non-current assets. So we start with non-current assets. What are the non-current assets? The first is, it's called fixed asset, under which we have tangible assets. What are tangible assets? Assets that we can see, feel, touch, etc. Could be machinery, could be building, could be land, etc. Intangible assets could be goodwill, because you cannot see goodwill, could be copyrights, could be software. We've purchased software for the use in our business, these become intangible asset. Capital work in progress, if work is being done, let us say a building is being constructed, it's not yet building, but it is in progress, therefore it's called capital work in progress and is a part of fixed assets. If there are intangible assets under development, maybe software is being developed, it is still under development, this becomes intangible assets under development. So under non-current assets, first item is fixed assets, and under fixed assets we have tangible assets, we have intangible assets, we have capital work in progress, and we have intangible assets under development. So basically it's tangible capital work in progress and intangible capital work in progress. Next item is non-current investments. By non-current investments, we mean the investments which we intend to hold for a long period of time, for a period greater than 1 year at least. Such investment may be in deposits, maybe in debentures of another company, maybe in the shares of another company, etc., etc. Next, we have deferred tax asset. Just like we had deferred tax liability, there is another item, deferred tax asset. As we said before, these arise because of the difference in profit as per financial books and the profit for income tax purposes. The details of this, the computation, etc., we would understand at a different level, at a more advanced level. If there are any long-term loans and advances, if we have lent money, if the company has lent money to another associate, to some other institution, to some other person for a long period of time, that is, it is repayable only after a year or more, then it's called long-term loans and advances. If there are any other non-current assets. One example here would be a discount on issue of shares, which is to be written off after a year. That would come under other non-current assets. Under current assets, we have current investments, that is investments which are expected to be sold within a period of less than 1 year. Inventories, stock, trade receivables, which is nothing but debtors and bills receivable. Cash and cash equivalents, that is cash, balances with banks, etc. Any short-term loans and advances, if we have lent money, if the company has lent money for a short period of time, this asset would be shown under short-term loans and advances and other current assets. Similarly, if this discount is to be written off within a year, that would come under other current assets. So the asset side of the balance sheet is broadly consists of only non-current assets and current assets. Under non-current assets, one item we have is fixed assets, which includes tangible assets, intangible assets, capital work in progress, and intangible assets under development. Besides this, we have non-current investments, deferred tax assets, long-term loans and advances, and other non-current assets. Under current assets, we have current investments, we have inventories, we have trade receivables, we have cash and cash equivalents, short-term loans and advances, and other current assets, assets which we were not able to classify in any of the above 5 headings. We'll just take an overview of the entire format. This is the format of the balance sheet, the vertical form of balance sheet as per Schedule 3 to the Companies Act 2013. Particulars, note number, current year figures, previous year figures, rupees in thousands, rupees in lakhs, rupees in crores. We start with equity and liabilities. Start with the shareholders' funds. Under shareholders' funds, we have share capital, reserves and surplus, money received against share warrants. Then we have share application money pending allotment. And next, non-current liabilities. We're coming to the liabilities. You have non-current liabilities and current liabilities. Non-current liabilities, current liabilities. Under non-current liabilities, we'll have the long-term borrowings, deferred tax liability, any other long-term liability, and long-term provision. Provident fund, gratuity, etc. are examples of long-term provisions. Under current liabilities, we have short-term borrowing, trade payables, which includes trade creditors and bills payable, other current liabilities, and short-term provisions. Short-term provisions include proposed dividend. Other current liabilities would include dividend payable, unclaimed dividend, unpaid dividend. This total gives us the total of equity and liabilities. Equity being liability to owners, liabilities being liabilities to outsiders. Under assets, we have non-current assets and current assets. What are the non-current assets? Fixed assets, which may be tangible assets, intangible assets, capital work in progress, or intangible assets under development. Besides, you could have, what are the other assets? Non-current investments, deferred tax asset, long-term loans and advances, and other non-current asset. Similarly, under current assets, we have current investments, inventories, trade receivables, cash and cash equivalents, short-term loans and advances, and other current assets. This, in brief, is the format of the balance sheet as per Companies Act 2013.